In this video, we're going over the ultimate beginner's course here to technical analysis, guys. It is R Trades back here with another video. I want to thank you for joining me. If you like this content, please make sure to like, comment, subscribe, and use those affiliate links in the description box below, guys. Apex Trader Funding currently making some changes to their system. Might be worth checking out again, guys. 80% off using the coupon link in the description box below. Okay, guys, so there are 7 main patterns, main things that we're going to talk about here today, but I'm going to slightly change it up from someone else's video and call it ICT Patterns instead of breakout patterns. Okay, guys, so the 7 things that we are going to talk about today that should help any beginner out and could be a refresher for those more experienced traders out there. We're going to go through number 1, candlestick charts. Okay, so I'm going to talk to you about an open, high-lows, close bar, how you can read a candlestick chart, how you can basically use a candlestick chart. Number 2, guys, we're going to talk about trending markets. I'm going to show you how you can identify an uptrend, how you can identify a downtrend, and how you can identify a trendless or a trading range market. Item number 3, guys, we're going to talk about basic support and resistance. And when I talk about support and resistance, I mean we're going to talk about just horizontal line, straightforward support and resistance. Okay, guys. And then the next item we're going to talk about, guys, is we're going to talk about indicators. Going to show you some basic indicators that I like to use, talk to you about how you can add them on the chart and what they're. Might even go into how you can find out more information about indicators. Okay, and then next thing, guys, is we're going to talk about candlestick patterns. That's item number 5. Item number 6, we're going to talk about chart patterns, some basic chart patterns. And item number 7, because I'm a groundbreaker, newsbreaker, ground shaker, and I want to sort of change things up, is we're going to talk about ICT patterns instead of, quote, breakout patterns. This is going to be the first item. Okay, guys, so we are here on Tradingview. What is Tradingview? Well, Tradingview is one of the leading desktop and software packages to open up the futures market, futures, forex, stocks, bonds, whatever you want. If you go to www.tradingview.com or you use the affiliate link in the description box below, you can get started with a basic plan. Tradingview is what I use, but there are plenty of other charting software packages out there, from TD Ameritrade or now Charles Schwab's Thinkorswim, all the way to Sierra Chart, Jigsaw Chart. I'm sure that many of you are familiar. Okay, guys, so with that being said, what is a candlestick chart? Well, a candlestick chart is a way of viewing price action similar to a bar chart, but pretty different from a line chart. So, for example, the traditional way that in the United States that stock data would be shown would be what's shown on the screen now. These are open, high-lows, close bars. Japanese candlestick charts come back from about the mid-16th century of Japan, and they basically show you the same information that a bar chart does, but displayed in what looks like a candlestick. So let's go to an individual candlestick and let's see what information is showing. So first, guys, when you are on TradingView, how you can get to the different chart types here is at the top of the screen. If you click down from bars, click candles, this is how you get on a candlestick chart. There are other charts available. For example, you can look at a stock chart using a line. Okay, the line is not something that I use at this time, but I've used it before, and it can show you plenty of information. So, guys, candlestick chart's not the only way that you can view a stock chart. Okay, so what is an individual candle showing you? So first, I've shown you how you can get on a candlestick chart. Now I want to talk to you about, okay, what is the information that's being shown? So if you look at the top of the screen here, I've clicked the 1H symbol. On TradingView, if you just start typing on your number key, you can actually change this to any number that you want, any number of minutes. But right now I have it on a 1-hour chart. If you click down here, you can see on the hour chart. If you click down on the intervals, you can see that if you just click that little favorite button, it will add and remove whatever time frame that you want. Okay, guys, so what is the information being shown by a single candle? Let's take this candle, for example. So notice that this candle is 1 hour in duration, and you know that because I've set it to be 1 hour. If I click on 30 minutes, it goes away, right? So 1 hour. If I hover over with my cursor, notice at the bottom of the screen that it says Friday 05 July 24 at 1500. What that means is that this candle is showing the open, the high, the low, and the close of the micro ES futures for 1500 to 1600 New York local time on Friday the 5th of July. Okay, that's exactly what that's showing you. If you go at the bottom of the screen, you'll notice that I have it set to UTC -4. So instead of setting it to my local time, which is Chicago, I set it to UTC -4, which is New York local time. Okay, and then also notice that I have it on the electronic trading hours on the sessions instead of the regular trading hours. Okay, so this individual candle, what is it showing you? Well, if you look at the top left of the screen, notice that it says OHLC. That stands for open, high, low, and close. So this one candle is showing you, number one, for the start of that hour, where did price open? It's showing you the high, as in the highest tick or the highest value that the micro ES futures traded for that hour of time. Okay, and then it's showing you the low, which is the lowest value. It's not really a dollar value. This isn't a stock chart per se. It's very similar to a stock chart, but it's not technically a dollar value. It's just a index point value. It's showing you also the close, so where it finished for that hour. So guys, if you look at the top, notice that it says 5,618.75. Where do you see that on the candle? Where is that visually on the graph? When you have a green candle, and a green candle, guys, is what I've set my, this is something that I should show you as well. Guys, if you go to your stock settings, notice that I have my up candles to be green and my down candles to be black. You can set your candles to be whatever you want. You can set them to be both the same color, two different colors, all kinds of different colors. It doesn't matter. But for purposes of watching this video, guys, you should know that my up candles are green and my down candles are black. Okay, so the open there, it says 5,618.75. Well, if I hover over that value there on my cursor, look at the right side of my screen, and do you see how that says 5,618.75? I say spot 75. It's like a British way of saying it. I don't know why I say it that way, but I do. 5,618.75. Well, notice that because the market closed higher, so if you look at this candle, top left of the screen, do you see where it says 5,622.00 or 5,622 evens, as they would say in trader lingo? Notice that 5,622 is higher than 5,618.75. What does that mean? That means for that hour in time, the S&P 500 futures closed, they ended that hour higher than when they started that hour, Okay, so again, the reason why the candle is green, or why we refer to it as a bullish candle, a green candle, or up candle, is because for that period of time, in this case it's an hour, for that period of time, the instrument that you're looking at, in this example, it's the micro S&P 500 futures, or MES for short, because during that hour of time, the market closed or ended that hour higher than when it opened it. So that's why that candle is green. And when you're looking for where this information is, the easiest information to see on a candle chart is the high and the low are always going to be demonstrated by the highest point on the candle. So for example, when it says OH, the H is 5,625.75. Okay, so notice that if I hover my cursor over 5,625.75, notice that that is the highest point of that hourly candle. And so also notice at the top left there, the H value is 5,625.75. That is the highest point that the market reached in that hour of trading. Okay, similarly, the lowest value that candle reached for that hour of trading was 5,617.50. 5,617.50. That is the lowest point that that candle or that bar, you'll sometimes hear candles referred to as bars, but for this video to be accurate, I'm going to just refer to them as candles. Notice that that is the lowest point on that candle, on that hour of trading. Okay, now let's get to the close. The close is this portion of the candle where it says 5,622. Notice that is the fat part of the green candle. So let's take another example of how we can read the open, high, low, and close for a green candle. Okay, guys, so I'm just going to highlight here the Monday, 8th of July, 0200 or the 2 a.m. candle. There it is. Okay, so I have highlighted here a candle that we're going to examine, and I'm going to zoom in on it. First off, you can tell when this price action happened because if I hover my cursor over it, notice at the bottom of the screen it says Monday, 8th of July, 2024, and it says 0200. That means it was 1 a.m. Chicago time or 2 a.m. New York time, and I set my clock to New York time. So if we look at the top left of the screen, when I hover my cursor over it, notice that it says open 5,611.25, high 5,614 spot 25, low 5,610 spot 50, and the close 5,614 spot evens, spot 00. Well, let's go through that candle and let's see all four of those pieces of information. So where do we open? Remember that on a green candle, okay guys, so I'm just, what I'm doing is I'm just making it an arrow. Okay, so notice guys that the bottom of the candle here is at 5,611 spot 25. So notice that the open of this candle right here, if I hover over it, says 5,611 spot 25. Visually speaking, it's that notch right there where the square begins or where the upward facing rectangle begins. The next bit of an OHLC candle or an open or a high, open, high, low candle is, and I'm just going to change this really fast to be the other way. Okay, guys, so notice that the high of that candle, it says, 5,614 spot 25. Where is that located? Where can you see that on the candle? It's that very top notch, okay? But that's not where the market finished that hour. That's the highest value that the S&P 500 futures reached, the highest numerical value that hour reached on this instrument, but it is not where the market finished at 59 minutes and 59 seconds in. That's not the final value of the hour. That's just the highest value that it reached during that hour, which is why the upward portion are these little thin lines. They're called wicks. So that part of the candle that is not what's called the candle body or within the open and the close is called the wick or the tail. Okay, guys, so the highest part of that candle, notice it's 5,614 spot 25. Okay, now the next value that we want to look at is the low. So where's the low? It's that lowest little portion of the candle right there, 5,000. Notice it says 5,610 spot 50 at the top left of the screen. Okay. Notice that I'm pointing out here with my arrow. That's exactly where the lowest point of the value is. Finally, guys, the reason that it's a green candle is because notice that the market in this particular hour finished its hour of trading higher than where it opened its hour of trading. So it's not the highest point of the candle, it's that little notch in the square. Notice it says 5,614. Okay. So guys, that is how you read a green or an up candle. Again, you can set on any charting platform, you can set your candles to look however you want your candles to look like. Okay, guys, next item that I want to discuss is a down candle, a bearish candle, or you might hear it referred to as a down candle, a bearish candle, or a black candle. Okay, so let's move along in our hours here, and let's take this example here. So I'm going to highlight the candle that we're going to look at. And first off, if we hover our crosshair over it, notice at the top, at the bottom of the screen, it says Tuesday, 9 July 2024, 10 a.m. That means that this was the hour between 10 a.m. New York local time and 11 a.m. New York local time on this instrument on the 9th of July. Okay, so notice here on the top left of the screen where it says OHLC, the O is 5,640.25, the high is 5,644.75, the low is 5,630.50, and the close is 5,637 evens. Okay, so notice that it opened at 5,000, or the O is 5,640.25. The close is 5,637.0. What do you notice about those two numbers? Well, notice that the C, or the closing value, is 3.25 points lower than the opening, or the O value. What does that mean? That means that the market was trading 3.25 points higher at the start of the 10 o'clock hour than when it finished the 10 o'clock hour. That's why this candle, instead of being a green candle, is a black candle or a down candle or a bearish candle. That's why. The closing value is lower than the opening value. So how do we read a black candle? Very simply. So remember that in a green candle, the opening value here, the opening value was lower than the closing value. So the O value here was the bottom of what's called the candle's body, or that little rectangle portion of the candle. Well, because we're on a black candle now, or a down candle, the start of the hour is the top notch of the square. Okay, that's why. So on a black candle, the opening value is the top notch of the square. So I'm just showing you some more examples of top notches of the square. On a black candle, the opening value, or the O value, is the top notch of the square, whereas on a green candle, it's the bottom notch of the square. So the opening value for the candle that we're looking at, or the candle in question, is 5,640.25. Okay, so if I hover my cursor over the top notch of the square, look at the right side of the screen, or the y-axis. Do you see how it says 5,640.25? Notice that's exactly where I have my arrow. Okay, the next value is the high value. The high value for both green candles and black candles is always going to be the top notch, the very top, tippity top of the candle. So notice here that the top value of that candle was 5,644.75. Okay, and I've pointed that out here with my arrow tool. The next value we're going to look at is the low. Okay, the lowest value on both black candles and green candles, or up candles and down candles, is always going to be the very lowest point of the entire figure, the entire candle. Okay, the lowest little point here. Okay, then the final value is the closing value, 5,637 evens. If I take my cursor, notice that that's the bottom notch of the square. So in a green candle, the closing value is the top notch of the square. In a black candle, the closing value is the bottom notch of the square. Okay, guys, so in the first 20 minutes of this video, I have discussed the basics for how you read a candlestick chart. Some of the other items here on a candlestick chart that I would like to go through is a couple of terms. So terms to understand. Terms to know for candlestick charts. Number one, we've been over the OHLC, open, high, low, close. Number two, I want to go through what is the body of the candle, the body, so body of the candle, and I want to go through the wick or tail of the candle. Okay, guys, so there are many different things that you can do with a candlestick chart, but the two terms that you should know right from the beginning is you should know what does it mean to be the body of the candle and what does it mean to be the wick or the tail of the candle. So what I'm going to do is I'm going to highlight a single candle here, which represents 1 hour of trading on the micro S&P 500 futures. Okay. Do you see this portion of the candle that is represented just there by the rectangle? Okay, just that portion of the rectangle that is between the opening value. So you see how it says that this candle opened at 5679.75. Notice that the C value, or the close value, is 5684.50. That means that the first price fluctuation in the 8 a.m. candle was the opening value, and the final price fluctuation for that hour of trading was the closing value. Well, guys, all of that action in between the open and the closing value, that is what's referred to as the body of the candle. In other words, it's the rectangle of the candle. On a black candle, it's going to be the exact same thing. It's just going to be the rectangle portion of the candle. That's what's referred to as the body of the candle. Okay? That's what's referred to as the body of the candle. Now I want to talk about what is referred to as the wick. Now, there are 2 wicks on most every candle. Not necessarily, but on most every candle, there are 2 wicks. So on this candle that I took the example of, notice that there's a large portion of that hour of trading that is not within the rectangle. That portion is called the wick, or tail of the candle. Okay, technically, all right, so it's that portion there. There are 2 tails to the candle. So the top portion here, that top portion of the candle is referred to as the candle's wick, and then the bottom portion below the rectangle is also referred to as the candle's wick. So guys, we are now 24 minutes into the video, and I have shown you, I've talked about Tradingview, I've shown you how you can turn on a candlestick chart, I've shown you how you can place your time frame, and I've outlined to you how you can basically read a candlestick chart. So at this time, here 24 minutes in the video, I'm going to take a quick break, and then item number 2, we're going to move on to our trending markets versus non-trending or detrending markets. Now, if I right-click here on TradingView, I can click Remove Drawings, which is going to remove all the drawings from the chart. So guys, just to recap, in the first section of this beginner's video to technical analysis, I've shown you how you can read a candlestick chart. Item number 2 is trending markets, how you can identify them versus non-trending markets. Okay, guys, so assuming now that we know how to read a candlestick chart, now we're going to get into section 2 of the Ultimate Beginner's Guide. Section 2 is going to be trending and non-trending markets. Okay, guys, so you've probably heard before of what's called a price trend. Okay, what is a price trend? Broadly speaking, a trend in price is a tendency for price over any given period of time to tend to move in one direction, either up or down. So whenever you're looking at a chart here, all you're looking at is you are looking at changes in price over time. Okay, so the x-axis there at the bottom of the screen is time, and the y-axis is price. All you're looking at is changes in price over time. When price tends to move higher or lower, broadly speaking, over any given period of time, but let's say, for example, in a few days. Let's say you have a 3-day period and the S&P 500 is tending to move higher. That's what's referred to as an uptrend. When the S&P 500 or any instrument tends to move lower, meaning that overall the changes in price are tending to lose value in that instrument or in that market, that's what's referred to as a bearish or a downtrend. If you are brand new to the markets, what you should know is that bullish refers to up and bearish refers to down. Don't ask me where that originally came from, but that is in fact the case. So if you're brand new to the markets, you don't know what bullish or bearish means. Bullish means upwards, bearish means downwards. Okay, guys, so how can we identify what's referred to as an uptrend? Well, here on TradingView, if we click on the second item, the trend line tools, or if we click down Alt-T on our keyboard at the same time, which is not working for me right now, but assuming that that did work, notice that we have a trend line tool. Okay, so it's a basic line, and it's just showing you price over time. An uptrend at its very core is connecting two or more lows over any given period of time that the first low is lower than the second low. In other words, guys, an uptrend, a trending upwards market, is a market that forms higher lows and higher highs. So higher highs and higher lows. And how you can draw a trend on your TradingView chart is simply going to the trend line tool and connecting two lows together. So let's take this example of an upward trending market, and I'm going to outline to you how you know it's an upward trending market. So notice here that the first low that we're looking at is from the Friday, the 5th of July at 8 a.m. in the morning. The second low that we're looking at here is Friday, the 5th of July at 10. Okay. When the market pulls back, or in other words, it makes this high here. So we have a high here at Friday, the 5th of July at 1500. Notice that when the market comes back down for a few hours, notice that the next low, what is that? That's higher than the first low. So we have a high here, we have a high here, we have a higher high, we have a higher low. That is basically an upward trending market. Higher highs and higher lows. You can identify an upward trending market by simply taking two or more lows and connecting them together using a trend line tool. So in this example, I'm just going to leave that there. Okay, so notice that our next high that we form on the Monday, the 8th of July at the 9 a.m. candle, notice that it is higher than the prior high. Notice that we form another low. Notice that it's higher than the prior low. That is continuing to show upward trending. So notice that our next high is higher than the prior high. Next low is higher than the prior low. We continue to trend higher. Now, ignoring this section of price action for a moment. So we're just gonna ignore this section of price action for a moment. What do we see? Again, we have a higher high, we have a higher low. Now guys, these are not always going to be pretty. Basic idea is that if you have a higher low and you have a higher high, you have an upward trending market. Now guys, the idea behind trends is that they're not perfect. The idea behind trading a trending market is it is more likely that the market is going to continue in the same direction in which it has already been traveling, or inertia basically. It is more likely than not that an upward trending market, if correctly identified with higher highs and higher lows, it is more likely than it is unlikely that the market will continue moving in that direction. That does not mean that if you take a buy order, or what's called as a long, if you buy the market in an upward trending market and you lose money, that does not mean that the trend was not there. Guys, trends can change. They can change all the time. The point is that it's just a game of probabilities, and that if you are trading an upward trending market, it is more likely that price will continue moving upward in the near term than it is going to change trend. Okay guys, the next item that we are going to talk about is how to, can I get my drawings back? Okay. I want to talk about how you can identify a downtrend. We're going to spend this portion of the Ultimate Beginner's course on trending and detrending markets. How you can identify an uptrend, a downtrend in stock charts. Okay guys, so now we're going to talk about a downtrend. Okay, now recently the stock market has really just been going higher, so it's kind of even difficult for me to find an example, but I will give you a pretty rough example here. Okay, so first, what have I done? I've gone to my favorites toolbar. My favorites drawing toolbar is on the bottom left. I've clicked on my trend line tool, and then I'm connecting two highs. The first high just needs to be higher than the second high. Now, that's how you draw a downward facing trend line. Okay, how do we identify a downtrend? Well, we start with our first high. Our next high should be lower than that prior high. So I've highlighted one high here. Now I'm going to highlight my next high. I'm going to highlight my next high and my next one and my next one. That's 4 highs, and each high is lower than the previous high. That is one half of the equation. The other half is you need lower lows. So I'm going to highlight my first low here. Or we can even say this is our first low. Now, we do have a little bit of a higher low here, and then this is not the world's cleanest downtrend, but nevertheless, notice we have a second low that's lower than the first one. So we're bouncing down. We're bouncing down. We're bouncing down, bouncing down, bouncing down. That is how you identify a downtrend. A downtrend is lower highs over time and it's lower lows over time. How you can draw a downward trending market is by connecting, using the trend line tool. You can connect one high that's higher than the next one, and there you have a downtrend. Now, some of you might be wondering, is it possible to have a downtrend within an uptrend, or an uptrend within a downtrend? Because you're immediately thinking, hey, this isn't perfect. Yeah, it's not perfect. Trends come in all different time frames. They come in all different shapes. There are short-term trends, so there are trends that might last 5 to 10 minutes. There are medium-term trends, and then there are long-term trends. So now I want to talk about, first we've covered how to identify an uptrend and a downtrend. Next, we're going to cover time frames, trend times. We're going to talk about short-term, medium-term, and long-term trends. Okay, guys, so now we're going to talk about trends over time, or in other words, we're going to discuss different lengths of time. Guys, the easiest way to start, in my opinion, is to start with long-term trends. So what do I mean by long-term trends? Well, let's go up here to the weekly chart. So remember how we were just on the hourly chart and every candle represented 1 hour of time? Well, now we're up on the 1 week chart. And the 1 week chart represents, each one of these candles represents a full week in time, an entire week. So when you have a trend on this time frame, you can consider it a long-term trend. Long-term trends tend to be things that can last for months, years. Okay, for months and years, weeks, months, and years. So noticing where the stock market, or the S&P 500, in the past, since April of 2024, April of this year, if we connect our low, is an uptrend. Okay, we know it's an uptrend because we have one low, we have a second low that is higher than the first low. Now, in addition, that this high here that we formed on the 1st of April 2024, notice that the week of Monday, the 20th of May, is slightly higher than that as well. So we have higher highs and we have higher lows. That is a weekly uptrend. That's a long-term uptrend. Okay? So we've identified how we can basically just go to a monthly chart, weekly chart, even a daily chart to start with a long-term trend. Now, guys, let's go to the 4-hour chart. And let me just bring my, okay, guys, so what I've done here is I've clicked on the 4H. Every candle now is 4 hours. So what I'm going to do here is I'm going to take my trend line tool and I'm going to connect it from the first low, and I'm going to connect it through that second low. All you need to draw a valid trend line is 2 points. So first low, second low. This is what we would refer to as a medium term or an intermediate term trend. Okay, now guys, these are a little bit subjective. You could call this a long-term trend, but notice that broadly speaking, the market has been trending higher. So broadly speaking, the S&P 500, although we have periods where the market's moving sideways and we have periods where the market was even moving down, but overall from Friday the 31st of May up until now, Friday the 12th of July, notice that the market has broadly been moving higher. Okay, timeline, the time frames of trends, long-term trends, medium-term trends, and short-term trends. We are here on a 4-hour chart, and I'm discussing how this is basically an intermediate term trend. Okay, guys, and then finally, let's go down to the short-term trends. So short-term trends are things that, I would say 30 minutes and below, but you could include an hourly chart on that. Okay, guys, so I know that this is like not the world's best trend, but remember, it's technically only 2 points. This is actually a downtrend. Okay, so what do we have here? We have a high and we have a lower high. We have a low, we have a lower low. So technically what you're looking at, even though on a 15-minute chart it looks pretty nasty, is you're looking at a downtrend. So guys, as you can imagine, when studying trends, there are different time lengths of trends. There are trends nested within trends. Now I want to talk about a detrending market, or a market that is really not trending. Okay, so what does it look like when a market doesn't trend? I'm going to go back up to the hourly chart here. What does it look like when the market is taking its time? And in other words, it's not really moving. It's not moving in one direction or another. Okay, guys, so you can have uptrends, you can have downtrends, and you can have no trend. Okay, guys, so if a detrending market is pretty easy to identify because it looks like when the market is going sideways. Okay, so we take this broadly speaking, and guys, nothing is perfect. Okay, nothing is perfect, but generally speaking, if we take what we see here in this rectangle box, notice that the market forms a high, it forms a low, forms a slightly higher low, but it forms a lower high. Okay, notice that the market is basically not moving too much, right? That is a detrending or a market that is within a trading range. Okay, that's how you can identify that, is when it's kind of looking like it's going sideways. Now, why might the market move sideways? Well, you could be, number one, in the overnight session. You could be on a holiday. So it could be a holiday shortened trading day, or you could be between the hours of, like in the evening session, and in most of the overnight session, guys, the S&P 500 doesn't tend to move that much. The futures don't tend to move that much, although they can. And then number three, the market could be waiting on some economic news to come out, so the market might not be trending yet because, let's say, Jerome Powell's about to speak, or the inflation data is about to come out. There are different reasons why the market might not move for a period of time. How you identify it is look for when the market is moving sideways, it's not making new highs, it's not making new lows, sort of staying within a defined range. That's a detrending market. Okay, guys, so in this video, we have now covered candlestick charts. We've also covered trends. Now I want to talk about support and resistance. So section 3 of the Ultimate Beginner's Guide. Support and resistance. Support and resistance are broad concepts that in this video I'm just going to stick to basic horizontal support and resistance. So what I'm going to do is I'm going to add on a horizontal line here to my drawing tool. And what I'm going to do is start. So what I've done is I've outlined this portion of price action. What support and resistance, what is it? Well, guys, support and resistance are the idea that for a given period of time, to know exactly what amount of time, but that for a given period of time, prices will have a difficult time going below a certain price and a difficult time going above a certain price. So, for example, I think the easiest way to demonstrate support and resistance is just to show a brief example. So we take the example of our price action here located within this square. Notice that the high that we formed there at 5,645.75, notice that for a period of time, we'll call it from Monday the 8th of July at 1800 up until Wednesday the 10th of July at 1100. Notice that this stock price, or the price, had a difficult time going above 5,645.75. In other words, price is resisting going higher than that. It is resisting going higher than that price point. That is basic resistance. Conversely, notice that price had a difficult time going below about 5,628.25. That's what's called support. So guys, support is to the downside, resistance is to the upside. Support on a trend line basis, meaning that you can have the concept of rising support or falling resistance. But in this video, I'm strictly going to stick to horizontal support and resistance and look at times and prices that the market is having a difficult time getting above and a difficult time getting below. So right now, and this is like current, as I'm making this video, this is really current. Notice that the market forms what's called a double top. It's a basic form of resistance. So notice that the market is having a difficult time getting above 5,707.75. How long the market is going to have a difficult time getting above that price, I don't know. All right, you don't know, nobody knows. But the point is that for that period of time, the market was resisting going higher than that price. Similarly, okay, we take about 5,628.25, and notice the market did in fact, and this was on an economic news release, we did in fact go below 5,628.25, but for the most part, on 3 different occasions. We have occasion number 1 here, we have occasion number 2 here, and we have occasion number 3 here. Notice that the market is in fact having a difficult time going below about 5,628.25. That's what we call support. So guys, just to recap here, resistance is above, support is below. And what you're looking for is you are looking for when the market has a difficult time going above a certain price point or below a certain price point. And that's how you identify support and resistance. So again, you are looking for when the market has a difficult time going above a certain price point or below a certain price point. Let's see if we can have find some more examples of support. Okay, so let's say broadly speaking, right there. Guys, this is not a perfect science. Okay. So we take the price point of 5,511. Okay, we'll call it 5,511. And this is on an hourly chart. All the way from the period, and I'm going to outline this for y'all, all the way from the period of about the Monday, the 24th of June, to Tuesday, the 2nd of July, which is about a week time frame. Notice that every time that the S&P 500, and I'm even going to call these getting close. This is not perfect, guys. It's not perfect. This is an art more than a science. Right? But notice that every time that the market tried to go below about 5,511 points, or maybe 5,510 points, give or take a total of 7 points. Notice that every time that the market tried to get below that number, 1, 2, 3, 4, 5, 6, we could call these 7 or 8. Notice that every time that the market wanted to get below that, it had a difficult time doing that. That's what we call support. That is the market supporting that. The market is supporting that price, indicating that the market does not really want to go below that price. Now, conversely, I want to draw your attention to resistance. So let's talk about resistance, and we're going to call it right there, 5,553. Okay, so notice that 1, 2, 3, 4 times the market tried to get above about 5,553, and here at the beginning of my example, we dipped above it, or we traded, we briefly got above that price point. But notice that between about Monday the 24th of June to Thursday the 27th of June, notice that the market had a difficult time rising above about 5,553. That is what we call resistance. Now guys, can you use resistance diagonally? Does it just have to be horizontally? No. But in my opinion, and especially for a beginning trader or beginning technical analyst, stick to horizontal support and resistance. Okay, guys, so in this portion of the Ultimate Beginner's Guide, I covered support and I covered resistance, how to identify it, what you're looking for, and sticking to horizontal support and resistance. Now I want to get on to item number, section 4. Section 4. Ultimate Guide to Technical Analysis. And that's going to be indicators. Okay, guys, so indicators, something that you've probably seen on plenty of people's charts. The first thing that I'm going to do in this portion of the video is I'm going to discuss on TradingView how you can access your indicators. So at the top of the screen here, you can see that it says indicators, metrics, and strategies, and it also gives you the ability to click backslash or forward slash. So I'm going to click this button here. I'm going to go down to technical indicators. Now notice that the list is very, very long. Very, very long, guys. There are a number of indicators, and how indicators work is they are mathematical models that show you price in a different way. Okay, there are all kinds of different indicators. The first set of indicators that I want to talk about is I want to talk about a simple moving average. Okay, so what I've done is I've added what's called an SMA or simple moving average onto the chart, and we'll put it at 20 period length. Okay. The blue line here, what it is showing the average price for the past 20 candles. So as we can see, the average price for the prior 20 hours is 5,657, taking the prior 20 candles. The idea behind a moving average is that when price is above the moving average, we are trending higher. When price is below the moving average, we are trending lower. Additionally, when you cross over a moving average, that is traditionally seen as a sell signal. And when you cross above a moving average, it's traditionally seen as a buy signal. Additionally, guys, remember we talked about the concept of support and resistance. There is an idea in moving averages that when price touches the moving average, it should support price. So when price comes down to an average chart or an average price, price should rally or it should resist that average price, guys. Again, not something that's perfect, but something that I think needs to be mentioned. So the first set of indicators that I wanted to talk about are simple moving averages. Now, there are other forms of moving averages. So, for example, there is an exponential moving average. So the blue line now, what it does is it weights the nearer price action heavier than it does the past price action. So, for example, on an exponential moving average, I can change it to be, let's say, 20 hours of price action, and then notice that it comes down, right? It comes down. That's because instead of looking at only 9 candles, now it's looking at 20 candles. The difference between an exponential moving average and a simple moving average is that the exponential moving average is weighting the nearer candles heavier than it is the back candles. Now, one idea for using moving averages is, let's see, ribbon, is what's called a moving average ribbon. A moving average ribbon, it's not the way that I trade, but the way that I trade is not the only way to trade. So notice the moving average ribbon, what it does here is it's going to add on different moving averages on the chart. In this example, 4. They're all simple moving averages based on the closing price of that hourly candle. The yellow is the 20 period. The orange is 50 hours, and the darker orange is 100, and the red is 200. So notice that the red line here is the furthest away from price because price has generally been trending higher. Then notice that the other colors of the line. So a moving average ribbon is one way that you can analyze price trends. All right, not the way that I do it, but it's one way to do it. Okay, guys, now I want to talk about what's called oscillators. I want to talk about oscillating. So we've been over moving averages. The next item is oscillators. The first and probably one of the most popular oscillators is what's called the Relative Strength Index, or the RSI. The RSI is a way of calculating price that should show you when it's above the 70 value, the idea is that the market is overbought, and when it's below the 30 value, you could also set this to be 80-20, but the out-of-the-box settings are 70-30. The idea is that when the market has moved too far too fast, the market should come back in the opposite direction. Or when it's gone below the 30 line, the market has gone too far too fast to the downside and should move in the opposite direction. Okay, there are other oscillators out there other than the Relative Strength Index. Another one is going to be what's called the stochastic. So the stochastic is another form of oscillator, an overbought, oversold oscillator. You can do more research on this. I'm just showing you the category of indicators. And what it does is it takes the prior price action over time and determines, okay, has the market, according to this mathematical model, that's what the stochastic is, it's just a formula, has the market moved too far too fast relative to its prior price action? And guys, do I personally trade with a bunch of indicators? No, I don't. But I'm not telling you that you shouldn't. I'm giving you the information. So the category of technical indicators, we started with moving averages. Now I'm showing the category of oscillators. I also want to show you one of my indicators that I do like to use sometimes are the Bollinger Bands. The Bollinger Bands are an indicator that take price, and they start from a 20-period simple moving average. So again, we have a length 20, moving average type, simple moving average. And then what it does is it takes a standard deviation of that moving average, and it adds an upper band and a lower band on a standard deviation. The idea behind the Bollinger Bands is that when the market reaches that lower Bollinger Band, it should likely come back to the moving average. Or, again, a lot of different theories behind this, but it bands price by a simple moving average and by a standard deviation projection. You can change this to be 3 standard deviation projections, meaning that price should stay within these bands 95% of the time, or the out-of-the-box setting are a 2 standard deviation bands, which means that price should stay in 2/3 or 66% of the time. Okay, guys, one thing I also want to show you here on TradingView is I want to show you that you can actually look at all of your technical indicators right here. So here what I've done is I've clicked on the micro E-mini S&P 500 index futures. I've gone to the technicals tab, and we're here on the one day chart. Notice all the different oscillators that are providing a buy signal or neutral signal or a sell signal. Then we have all of our moving averages. We have a category of technical indicators called pivots, and they're all here laid out for you. And so you go on TradingView here and you're like, well, there's so many different indicators that I don't know if they're telling me to buy, sell, or do other. Go right here on TradingView, and there's the summary of all the different technical indicators. So that is something I think that's pretty useful. Okay, guys, now I want to talk about the indicator that I use all the time, that I have on my charts by default. I want to talk to you about the average true range, guys, and I've made a video on this. There are indicators that don't look at whether price is overbought, oversold, and they don't calculate price on an average basis. Instead, the indicator is telling you about what's called volatility, or price changes over time, otherwise known as delta. The average true range is an example of this. So the average true range, what it does is it takes the last 14 candles using an RMA smoothing method. So it just takes there's a calculation. It weights the latest candles a little bit heavier than the other candles. You're more than welcome to look up the to look up how the average true range is calculated. That's not the purpose of this video. I'm just showing you, you click on indicators, you click on average true range, and out of the box, it's going to be the average price over 14 candles. So the average price over 14 candles, excuse me, the average movement over 14 candles. So what it's showing you here, notice that the ATR here is at 13.84. Okay, that means that when the market closed on Friday, on average for the last 14 candles, it was moving 13.84 points. And that's what that's showing you. Now, why is the average true range important? For a number of different reasons. When the market is in periods of low volatility, meaning that, hey, the market's not moving that much, and I'm showing you these examples. So notice these examples of when the ATR is particularly low, and I'm highlighting when the average true range is particularly low. Why might the market not be so volatile during these highlighted periods? First, it might be because the stock market is closed. Remember that the futures markets are trading 23 hours a day, 5 days a week, whereas the stock market only trades between 9:30 New York local time to 4 o'clock New York local time, Monday through Friday. So the futures markets are open a lot more than the stock market. The futures tend to move the most when the stocks are also open. So basically, one thing that's nice about futures is you can reliably predict when there's going to be low volatility because it's probably in the overnight session or it's a holiday. Now, notice that every time that the market reaches a period of low volatility, meaning that it's on average only moving about 5 points, what is that followed by? That's right, it's followed by a period of high volatility. So notice that every time that the market makes a period of low volatility, it's followed by an expansion or a period of higher volatility. Now what I'm doing is I'm showing you that on the chart. So for example here, the market started moving a little bit more. Notice here, the market started picking up volatility. The market started picking up volatility. After here, again, the market started picking up volatility. What I'm showing you is that how volatility works is it works on a cycle. The market goes from periods of high volatility where every single hour it's moving a lot, or on average, in the S&P 500, it's moving like 12 points an hour. And then it's followed by a period of low volatility where it's only going to move about 4 points an hour. Now, guys, why is this so critical? This is how you can base your position sizing. If you have enough capital to where you can trade multiple contracts, you can change your position sizing based on how much you're expecting the market to move, okay? Based on how much you're expecting the market to move. So this is an indicator that does not tell you where price is going to go. It just tells you on average how much has price been moving over that time frame. In this example, an hour. So it's something that I have on my charts at all times. I always have the average true range on my chart. Okay, guys, that's what we call a volatility indicator. Now I want to also show you that here, just very briefly, guys, on Tradingview, you can find all different kinds of community indicators. If I go to indicators here, if I go to trending indicators, look, support and resistance, I have no idea what these indicators are showing. I just wanted to show you that there's tons of them, and you can use really market. Yeah, I don't know about any of these indicators, but you can use the community tab on TradingView to find some pretty unique indicators. That's what I wanted to point out there. Okay, guys, number 4. We talked about indicators. So to recap where we are in this ultimate beginner's course to technical analysis, we've started with candlestick charts, and I've shown you how you can read a candlestick chart. Item number 2, we've talked about trending versus non-trending markets. Item number 3, we've talked about horizontal or basic support and resistance. Item number 4, we talked about indicators, how you can place them on your chart, the different categories, oscillators, moving averages, and then volatility indicators as well. The average true range being an example of a volatility indicator. Number 5, we are going to talk about candlestick patterns. Candlestick patterns, guys. So we're going to circle back a little bit to section 5 of the ultimate. We're going to talk about candlestick patterns. Okay, guys. Section 5 of the Ultimate Guide to Technical Analysis is going to be on candlestick patterns. So remembering back to section number 1 of candlestick charts, how can we start to use these things sort of in combination? Well, guys, the idea behind candlestick patterns is that the shape of the candle, again, the shape of the candle or the shape of a combination of candles should indicate to you what the market is more likely to do in the future than not. So the first item, the different candlestick patterns that I want to talk about is I want to talk about the long trending candle. So we're going to talk about a few different basic candlestick patterns. We're going to start with the trend candle. We're going to talk about the spinning top, indecisive candle. We are going to talk about the overlapping candles. We're going to talk about long-tailed, long-wicked, or long-tailed. We're going to talk about long-wicked candles. We're going to talk about basic 2 and 3 candle patterns, and that's what we're going to talk about. We're also going to talk about including Mary Bozu's, including Bozu candles, and we're also going to talk about discussions of candles in time and context. Okay, guys. So the first type of candle pattern that I want to talk about is I want to talk about the trend candle. Now, what is the trend candle? The trend candle, whether it's a green candle or it's a black candle, should be a candle that is kind of broadly speaking, let's get back onto our average true range. It should be a candle that is between, let's say, 1 ATR to 2 ATR, meaning that it's with, between 1 and 2 ATR. Could be higher than that, but probably not. And let's just dive right into it and show you some examples. So these are all examples of upward trending candles. How do I know that? Okay. So if we block out this period of time, notice that the average true range for these 1, 2, 3, 4, 5 candles, the average true range, we're going to call it 5 points, going up to 6 points. First candle, using our average true range, notice that that is 12.75 points. At that time, the average true range, or the average candle, was only moving 5.36 points. So this candle, the very first candle, or the 1100 candle, is what we would refer to as a 2.5 or about a 2 ATR candle. Notice that it opens near its low and it closes near its high. That is how you can identify a trend candle. For an upward trending candle or an uptrend candle, it should be at least 1.5 to 2 times to even more, should be at least 1.5 ATR. What does that mean? If you're looking at that candle, whatever time frame it is, you want to notice what is the average true range for that time, and that the range of that candle should at least be 1.5 times that. So, for example, here we have a 5.56 on this candle example. Notice that we have the average true range at that time was 5.65. Well, notice using our measure tool here, notice this candle was 12.75. So this is a 2 ATR candle. It's 2 average links, opening near its low, closing near its high. That's a basic trend candle. A trend candle should indicate to you market strength. It should indicate to you a willingness to continue in that same direction. Okay, next candle. What do we notice about it? Opens near its low, closes near its high. The average true range for the Wednesday, 10th of July, 12 o'clock candle was 6.04. Now let's go and see what this candle, its range was. The range was 15.5. So this is a 2.5 ATR candle. So it's a large candle that opens near its low, closes near its high. That is an uptrending or an uptrend candle. This is a candle that should indicate strength in the market and a willingness to move even higher. Okay, that is what that candle is showing there. Next candle. Now, what is the average true range for the Wednesday, 10th of July, 1300? Average true range came in at that time at 6.23. This candle was 7.75. So this is an over 1 ATR candle that opens near its low, closes near its high. Arguably, this is not really what we would call a trending candle. This is just a bullish candle that's opening near its low and closing near its high. Is that really a trending candle? Not exactly, because it's not that required at least 1.5 ATR. Okay, so a good candle, a bullish candle, but not really a trending candle. The next candle here, the 1400 candle, what is the average true range? We come down, we look, it's about 6.33. What is the range of this candle? 8.5. So not really the 1.5 ATR that we're looking for. Now, what I also want to draw your attention to is notice that the market came down quite a bit lower before it closed. It didn't really close quite at its high. So this is what we would call a spinning top or an indecisive candle. This isn't really a trend candle. Okay. Next candle. So I want to look at trend candles. I also discussion of exhaustion candles. Okay, guys. So the next candle that I want to get on your radar is the 1500 candle. First thing I'm going to do is I'm going to look at the shape of the candle. We open near its low and we pretty much close near its high, but not exactly. Now let's look at what the average true range was for Wednesday, the 10th of July at 1500. 7.30. What is the ATR here? 19.75. So this is about a 2.8 or almost a 3 ATR candle. Now, this is not a trend candle. This is what's referred to as an exhaustion candle. What is the difference between a trend candle and an exhaustion candle? First, trend candles tend to be between 1.5 and 2.5 ATR. So trend candles don't tend to be so large that they're 3 or more times the average true range, whereas exhaustion candles tend to be about 3 ATR or more, 3 times the average true range or greater. Trend candles tend to be at the start of a new leg or a new trend or in the middle of a new trend, whereas exhaustion candles tend to be the market extending in the same direction much further and faster than on average. So they tend to come at the end of a move. An exhaustion candle comes at the end of a move, not at the beginning. Okay? So this candle here, it very much looks like a trend candle, but notice that it's coming towards the end of the trading day. It's about 3 ATR, 3 average true range, average true ranges. And notice that we have somewhat of a long wick here, guys. That is a sign that the market has probably moved too far, too fast. That is what we call an exhaustion candle. So guys, we've talked now, number one, about trending candles, and we've had a brief discussion of exhaustion candles, where the candle is moving many multiples the average true range, and it's already at the end of a move. That's an exhaustion candle. Item number 2, guys, we're going to move on to spinning top or indecisive candles and how they compare with trend candles. Okay, so trend candles are candles moving strongly in one direction. Spinning top candles are the exact opposite. Okay, guys, so let's block out a period of time. So I'm going to use my horizontal line tool here, and I'm going to block out this period of time. And I'm going to highlight spinning top or indecisive candles here using the highlight tool. All of these candles here that I've highlighted, what do we notice about them? Okay, so as we come in for the first candle, the average true range is 6.32 points. What do we notice right off the get-go? In that hour, the market only moved 3.75 points. Again, another example of an indecisive or a spinning top candle. We start with the average true range. What is the average amount that the market's moving? When a candle has a very small range compared to the average candle, you're probably looking at an indecisive or a spinning top candle. Not necessarily, but more likely than not. Our next example. Market's moving on average 5.68 points. In this hour, it moved 3.75 points. And if we go on, we would see the same thing. The basic form of a spinning top candle, literally looks like a spinning top. So it has a very small body compared to the wicks. And all of these examples, they're not perfect, but notice we have small bodies compared to the wicks. That's how you identify a spinning top candle. Now, if any of you are watching this video and you are more advanced and you're familiar with Japanese candlestick terms, I'm sure that you've heard of shooting stars, you've heard of dojis. I'm just classifying all of our indecisive candles as spinning top candles. Now, guys, indecisive candles, they relay the information to you that the market is not currently trending. That could be because it's the overnight session. It could be because there's an economic event coming out soon. It could be for any number of reasons, but it's a sign of low volatility and it's a sign of indecisiveness. Now, remember that low volatility is followed by high volatility. So when you see a long string of indecisive or spinning top candles, you're not really focusing on that. At the moment, you're focusing on, oh, okay, that probably means we're constricting volatility and we're about to expand. Okay, guys, so the second portion of the candle guide here is the spinning top or the indecisive candle. These should be 1 ATR or less. Again, they should be 1 ATR or less. The body should be the smallest part of the candle, whereas the wick should be the larger part of the candle. And they should really look indecisive. They should look like spinning tops. Okay, guys, item number 3 is I want to talk about identifying overlapping candles for when the market is not trending. And these are going to be signs of, hey, you probably don't want to be taking too many trades right now. Just getting rid of these drawings, overlapping candles, although these are a great example. So overlapping candles, guys, is the market showing you that it's not moving too strongly. Okay, so I want to move on to another example. Okay, so here's a perfect example. I'm going to highlight it for you. Okay, guys, the overlapping candles, and I'm going to show you the most strict example. Overlapping candles are otherwise referred to as bar coding. Bar coding is when the market is just not moving. When you see that you have many hours in a row, like here, for example, where the market is just not wanting to move. So 1 hour's down, the next hour straight up. My best advice for you when you have what it kind of looks like a barcode, right, is don't trade that instrument during that time. Just don't trade. Don't trade. That's the next candlestick pattern that I wanted to show you is overlapping candles, because that's a sign of when you need to go do something else with your life. Okay, item number 4, long-wicked candles. Okay, guys, so we've talked about trend candles, exhaustion candles. We've talked about spinning top and indecisive candles. We've talked about bar coding or overlapping candle. There's another really good example of that where you probably should just be not trading for that period of time. Now let's talk about long-wicked candles, and specifically I want to talk about what's called hammer candles. So the hammer candle, it basically takes on the sign of a hammer. How you can identify a hammer candle or a long-wicked candle is that it should quite literally resemble a hammer. And the best context that you should know is that the market should have reached a new short-term low, and then it should have rallied and closed higher. So it looks like a hammer. So here, I'm just going to show you some examples of long-wicked or hammer candles. There are long-wick spinning top candles, but those aren't what I'm focusing on here. So I'm really focusing on hammer and inverted hammer candles. So starting on the bullish side, context is really important. There's no portion of this video where I can talk about candles in isolation. Context is always important. Context is always important. So there's an example of a hammer candle here, or a long-wicked candle. Notice that the market formed a short-term low here. Notice that the market came below and then rallied higher, okay, forming what looks like a hammer. In context, guys, what I'm going to show you is there are many, many examples of this. And, guys, the color of the candle doesn't necessarily matter. You might be thinking to yourself, well, for a bullish hammer candle, shouldn't it be a green candle? Doesn't have to be, guys. It can be a black candle. It's not really important. There's another example here. Just the black candle. Notice that the market made a new short-term low, rallied, and formed the basic form of a hammer. That's what you're looking for. That's what you're looking for. Again, here, there's another example. Plenty of examples of these guys. This is not the only way that the market reverses, just so you know. But I'm just showing you examples of hammer candles where the market makes a new short-term low, rallies. This is an example of where it's a spinning top candle, but because of the context, because of the two short-term lows ran, that really does work as well. Okay, guys, this is another example of not a perfect long-wicked or hammer candle, but again, those are doji candles, but because of the context, they work. Okay, guys, and these don't even have to be small candles. I would argue here that would be a hammer candle, and there's a hammer candle as well. Now, let me show you what's called inverted hammer candles or shooting star candles, but basically they should be candles that form a new short-term high that the market rejects. Okay, so let's go down to our 30-minute chart, see if I can find some examples there. These should be after the market made a new short-term high. So here we have an example of a long-wicked sort of inverted hammer candle. The basic shape of this is like this. Should look like that. That's the basic shape. Forgive my drawing tools. This is not the only way that the market reverses, but that's another candle pattern that I wanted to make you aware of. Again, it should be right when the market forms a new short-term high. So context always matters. So notice that this candle comes in right as the market forms a new short-term high, and look at how that has that basic form of an inverted hammer. That's what you're looking for. That's a candlestick pattern that you can rely on. Okay, guys, that was that. Now I had another item. Okay, it looks like I'm not getting my text back. Okay, guys, so I talked briefly here about some basic candlestick patterns. I discussed trend candles, spinning top candles. So covered 1, trend and exhaustion candles. 2, spinning top, indecisive candles. Hammer and inverted hammer. And I also talked about incorporating ATR and using context. Okay, guys, so I briefly discussed here candlestick patterns. There are many, many more candlestick patterns out there. So I think that's all I want to talk about here on candlestick patterns. We are about an hour and 30 minutes into the video. The next item on the Ultimate Beginner's Course, section number 6 of the Ultimate Guide to Technical Analysis, is basic chart patterns. Basic chart patterns. I want to go through triangles, and I want to go through wedges triangles, wedges, rectangles, double tops. Okay guys, so in this portion of the Ultimate Guide to Technical Analysis, I'm going to cover basic chart patterns. And the first basic chart pattern that we are going to start with are triangles. Okay guys, there are many different types of triangles out there. In this video, I just want to cover how you can identify a triangle. Okay guys, so a triangle is a basic chart pattern, and how you find a triangle is you want to take where the market has a high, it has a lower high, and then where the market has a low and a higher low. So the market should essentially look like this. A triangle is showing you that the market is restricting its volatility. In other words, the market is staying within a tighter and tighter range. Now, the chart pattern has what's called, how you identify a triangle is like this. It looks like a triangle. When the market first breaks out of that triangle, that's called the breakout. That's what that is. Now, when the market reverses back in the other direction, we call that a reversal. I know. Brilliant terms. But here we have a basic triangle. The market initially breaks out to the downside of the triangle, and then it reverses back in the other direction. Now, if I use traditional candlestick analysis, notice that the market, using the top of the triangle to the bottom of the triangle, the market comes 1/2 of that distance down, and then it comes about 4 of these triangles higher when it reverses. Let's get another example of how you can identify a triangle. Basic chart patterns, and I mean basic, guys. Like, you should be able to get this pretty easy. Okay, triangles. Today's video is all about triangles. You got big triangles, you got small triangles, you got all different kinds of triangles. Guys, your triangles don't have to be perfect. Okay, so one type of triangle, flags and pennants. One type of triangle is what's called the flag or the pennant. So when the market has a move up and then it forms a triangle, notice that it kind of looks like a flag. And the distance, that distance between the low and the high is what's called the flagpole. And what you want to do is you want to take the distance of that low to that high, or it's really easy to clone. Just hold down Control, clone. The theory is that the market, when it breaks out of that pennant, should move the same measured move of that flagpole upwards, which in this case the market did. Okay, so a triangle which is formed after a move higher is called a flag or a pennant. A triangle that is formed after a move lower is also called a flag or a pennant. The triangle is an indication of a restriction in volatility. When the market breaks out of the triangle, that is called the breakout. So this is what's called the breakout. Okay, so we have the market breaks out, and immediately what does it do? It comes in above the prior high here. We then notice that the market curls back to the triangle. We call that the curl. The market's not always going to curl, but it sometimes does. And that's when the market breaks out of the flag, and then it curls back to the triangle. That is called a curl. And so notice that the market comes back into the triangle here and then again moves higher. That is called the curl. So the initial market breakout is called the breakout of the triangle. If it curls back to the apex of the triangle, which is about here, we call that the curl. If the market were to break out and then go lower, we call that a reversal. Okay? All right. Next thing I want to talk about are wedges. So wedges are similar to triangles, except they are just longer but they also, wedges are not super reliable, but they are something that I wanted to talk about. Okay, what is a wedge? A wedge is basically a longer triangle. So what I'm going to do here is I'm going to draw a trend line connecting the highs, and I'm also going to connect the lows. Notice that if I were to extend these out, notice that it forms basically a triangle. The wedge is a longer triangle. Okay, it's a longer triangle. The wedge, similarly, is chart pattern, breakout. The wedge, guys, is again a restriction in volatility, and we expect that the market is going to break out. When the market goes back higher, we call that a reversal. So that's how you identify the wedge. It's basically a longer triangle. Okay, guys, now I want to talk about the rectangle. The rectangle is a trading range. Okay, guys, so the rectangle. If I use my rectangle tool, the rectangle chart pattern should basically fit. Not perfect. Guys, the rectangle is a chart pattern like any other that basically shows you when the market is not trending. And we talked about support and resistance earlier. You can find rectangles when the market is tending not to move very much, or it's tending to stay within the same range. One thing that you can do with the rectangle is you can take the rectangle from the high to the low approximately of the rectangle, and if you extend out that distance, notice that the market, that's what's called a measured move. Okay, we'll talk about measured moves in another video and more in depth. I have talked about them before, but you can take the distance between the high of the rectangle to the low of the rectangle and expand that out, and that is what's called a measured move. That is one way that technical analysts predict how far the price should reasonably move. Okay, guys, now I want to get to the fun part of chart patterns. I want to talk about double tops, double bottoms, or triple tops, triple bottoms. Okay, guys, when the market reverses direction for any given period of time, so let's say that the market's going up, market's going up, 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 and then it goes down. Okay, the market, what it tends to do is it tends to visit the same price point multiple times before it changes direction. These are called double tops or double bottoms. It's where the price tends to go to the same high or the same low 2 times before it reverses. This is not perfect. You can have a double top in which the second high is higher than the first high, or a double bottom in which the second low is lower than the first low. The idea, though, is that roughly speaking, within a reasonable range, the price is going to the same point twice. So I want to show you very simple examples here of double tops. So guys, the double top is one of the easiest to see, but make no mistake, guys, just because it's easy doesn't mean it doesn't work. Double tops are something that you're going to see a lot. Now notice that, all right, on this example, the first high is actually lower than the second high. That's fine, guys. This is not perfect, but it is the market coming in. So the market makes an initial high. We then trade a little bit lower for a few hours, pop higher, and then we have a move down. That's the basic nature of a double top. Okay. Now the distance, right? So notice that this is a relatively short distance. Whenever you're looking at double tops or double bottoms, ideally they should be, a day trading perspective, around the same period of time. They shouldn't be too far. They should not be too far apart. Guys, so let's have a look at some more examples of double tops. Notice 2 tops here, market moves lower. 2, you could even say 3 over here, but notice that the market had a little bit of a move lower following 2 attempts higher. Now, let's see, more examples of the market double topping. Right here, you can see relatively equal highs where the market moved lower, double top. Here's a rough example of a double top here. Here we have, and I know that this is within the context of a downtrend. Nevertheless, that still is a double top. Now, guys, one thing I want to point out to your attention is that these really don't have to be perfect. Notice that roughly we have a double top here because we have an initial high, we have a move lower, and then we have the market again trying to rally, failing to rally, moving lower. That's the basic idea of a double top. The double top chart pattern, don't try to be perfect. Don't try and be perfect. Sometimes will the market look remarkably perfect? Yes. Don't try to be perfect. Broadly speaking, the market should try and make a high. It should pull back. It should make a new high or try to make a new high, visit that same price area, and then move lower. That's a double top. Okay, guys, let's look at double bottoms. Double bottoms, where the market visits the same low or roughly the same low twice before moving higher. Okay, guys, first example. I know what you're thinking. Hey, Reese, those aren't really that close to each other. I know that. But notice that the market makes a low, we rally, we spend a period of time, we fall again, we revisit roughly that same area, we move higher, double bottom. You could call this a triple bottom, but I'm calling this just a double bottom, visit low, revisit low, move higher. These don't have to be perfect, guys. Don't try and be perfect. We have a low, we have another low, right around that same price area. Perfect example here. Not perfect, but it's a great example here for double bottom. 2 attempts lower, move higher. Now, does the market always make a double bottom? No. Notice here we just have a single, or what's called a V bottom. What is a V bottom? A V bottom looks just like that. Market comes straight down, straight back up. That, and there we have an example of what's called a V bottom. Now, roughly speaking, that right there is a double bottom. Roughly speaking, you could call it a single bottom, but I'm calling that a double bottom. Okay, another great example of a double bottom where the market comes down, makes a low, rallies initially, comes back down, kind of revisits that same, makes a higher low, double bottom. Okay, that's our basic reversal pattern. Okay, guys, so in this portion of the Ultimate Beginner's Guide to Technical Analysis, I have gone now through candlestick charts. That's item number 1. Item number 2, I've gone through trending markets versus non-trending markets. Item number 3, I've talked about support and resistance. Item number 4, I've talked about indicators. Item number 5, we talked about candlestick patterns. Item number 6, we talked about basic chart patterns, including triangles, wedges, rectangles, double tops, and double bottoms. Now I want to talk about a couple of ICT patterns that you should be familiar with, guys. All right, ICT, or Inner Circle Trader, is a YouTuber that some people like, some people don't like, but he has a method of analyzing the markets that's based on inefficiencies and liquidity. The basic section number 7 of the Ultimate Guide to Technical Analysis is going to be basic ICT. Basic ICT. Okay, guys, what is basic ICT? Basic ICT is where's the liquidity and where are the inefficiencies. So when you are outlining basic ICT, which I have a video on this, notice where our recent highs are. That's where buy-side liquidity is. Where's our recent lows? That's sell-side liquidity. And where are any fair value gaps or inefficiencies in between those 2 points? Okay, basic ICT right there. Nothing crazy, nothing complicated, just basic. Is where's the buy-side liquidity? Where's the sell-side liquidity? Do we have any fair value gaps? Also, guys, basic ICT, that's basic ICT right there. Buy-side liquidity, sell-side liquidity, and then market inefficiencies. So where's our recent highs? Where's our recent lows? Are there any inefficiencies that should be noted? Basic ICT. Okay, guys, in this video, I have covered the Ultimate Beginning Guide to Technical Analysis, starting with candlestick charts. Number 2, starting with trending. Number 2, trending markets and non-trending markets. Number 3, support and resistance. Number 4, indicators. Number 5, candlestick patterns. Number 6, chart patterns. Number 7, basic ICT, buy-side liquidity, sell-side liquidity, fair value gaps. I want to thank you guys for joining me. Please make sure to like, comment, and subscribe.